the digitization imperative has indeed been brought into sharp relief by the coronavirus crisis and turned on its head. There's no doubt that banks and corporates alike have been forced to accelerate what they offer digitally in very rapid order. How much is digitization going to help narrow that gap? Where exactly is it going to play a role? How permanent will it be? What is needed to achieve that? These are just some of the questions which we hope to answer today, as well as the questions that you will be posing to us from the audience. So with that introduction, I'd now like to introduce onto your screens, Joe and Alex. Maybe I can begin with you, Joe. I mentioned you're based in Singapore. Maybe just to start on a slightly more informal note, Singapore went into lockdown relatively early, so you probably have more experience than many of us of working remotely. Are there any tips that you've kind of picked up over those couple of months that you're happy to share with us?
Yeah, sure. No, thank you, Hashim. I mean, wow, what an introduction. Fantastic. I'm really happy to be here, and thanks for having me on this panel. I definitely think in terms of working from home, one thing I've picked up that I always thought in the past whenever someone told me that, it's not that important, is actually to regularly take breaks and just take a breather, step away from the desk, and even just walk and wander around your living room. Ideally, if you have a balcony or a garden, walk out there, have some fresh air, come back to your desk. It just helps to focus so much more. It's really just about attention span, which of course also in the office, we do have to keep our attention span, but we have constant distraction as well from colleagues coming to our desk, from things happening around us on the floor, etc., etc. So yeah, definitely in order to focus better, I'd say regularly take breaks is my advice.
Excellent. And Alex, have you been taking your fair share of breaks?
Yes, indeed. Actually, I definitely agree with Johanna. I think it's very important to be organized and take breaks. Myself, I found it very useful to streamline at the beginning of the day what was important to do and how to make it more efficient to avoid to procrastinate during the day. Definitely.
Super. I think one of the things I find in terms of procrastinating is I'm constantly listening to music, but I've narrowed it down to a few songs that have helped me get through this. My favorite lockdown tune, if you like, is Splendid Isolation. If you haven't heard it, I strongly suggest you listen to that. Do you either of you have a theme tune to your remote working?
Personally, I would start with some classical music in the morning and something a little bit more active by the evening, to have a more efficient day.
And I would definitely say, if there is a tune, it certainly is what I normally start my workout at lunchtime, whether that's some yoga or whether I go running, depending on the weather. And that would definitely recently be Holiday by Madonna, probably because I'm craving to travel somewhere.
I think it's an excellent choice. Okay, with that, Joe. Obviously, no holiday at the moment. A lot of hard work on the instead. I mean, I set up some opening remarks about that trade finance gap, about where it might be falling proportionately and disproportionately. Maybe using your experience and utilizing your rich experience as a commercial banker, you can give us some of your opening thoughts.
Yeah, sure. No, absolutely, Hashim. And yeah, thank you very much for laying the land. And as you rightly say, this 1.5 trillion gap has been pretty consistent over the last few years, which of course is worrying. I think even more worrying is actually that there is some talk in the industry that it could even further widen if it's not being addressed. And could widen to, I think I've seen some figures to say, to 2.25 trillion, and so along. And I think it's important, of course, to, I know you looked at the areas most affected. I think we obviously also need to have a look at the reasons, and then we'll look into the resolutions. But I don't want to jump ahead too much, because that's certainly something that I think during this panel we want to arrive at to look at possible resolutions. I say from the perspective of and that's just my own perspective from working in the trade finance industry, but from the perspective of a commercial banker, being active in trade finance. Of course, what are the things that banks have in their toolbox to actually help companies globally to obtain trade finance? There is a pretty standard set of actually really good tools and instruments that have proven their value in some cases over centuries, and certainly have actually enabled global trade the way we see it today. And we do see that still, I mean, most global trade somehow has to be financed or supported by some sort of bank financing or bank credit, bank securities, etc. So there certainly is an important element, an important role for commercial banks to play. And we have definitely seen, therefore, of course, different iterations of the trade finance gap over the course of the years and its origin. If I'm thinking back to, and that was about the time when I entered into the industry, actually, if I'm thinking back to the global financial crisis, even back then already, surveys were being conducted by the various bodies like the ICC and the Asian Development Bank that are contributing together with the panel banks to the actual survey. There was certainly, after the global financial crisis, the trade finance gap was already there, but it was way more as a reason of lack of credit. Whereas right now, in the latest survey, the 2019 one, it's being cited by 76% of respondents, so really the vast majority, well, 2/3, three quarters, that actually regulatory reasons, AML, KYC, etc., play a role here. And that, of course, I mean, we need regulation as an industry. That's not just for the banks, but for anyone. We obviously need to make sure that everyone in the global trade sphere plays fair. We also need to make sure that we prevent the financing of terrorism, human trafficking, drug trafficking, etc., etc. So there is a very, very good reason why we have all this regulation. But of course, that can particularly hit SMEs, which is one of the groups you've mentioned, Hesham, because SMEs on the one hand are not as multi-banked and therefore don't have as many levers or as many choices and options to go for as, let's say, the multinationals. And then, of course, particularly SMEs in peripheral countries might suffer from the fact that there isn't also just not that many correspondent relationships between, let's say, the local banks that SME would have credit with, and then the global sphere of banks. Whereas, I mean, thinking about my own institution just for one moment, we're certainly a very important bank for the SME and mid-market world in the UK. We bank a large market share there, and that is certainly our strategic aim and goal, is to help Britain trade and support British companies globally. But therefore, of course, we also have built out a pretty strong correspondent banking network, which, as a British institution that has been around for many centuries and has got a long history, is, I wouldn't say easily doable, but is absolutely within our gift. Whereas if I'm thinking about some countries, particularly areas that are always being mentioned, is some smaller countries in Asia Pacific, but then also smaller countries in, let's say, the Caribbean or so, simply there, the local banking market isn't as big and as strong that they can really have all these relationships internationally. So already that makes it harder for, let's say, a local SME to go to their bankers and say, oh, actually, I need an import facility for goods I'm obtaining from, let's say, the UK, for example. That means, first and foremost, that local bank needs to have a relationship, of course, with relevant correspondents that can actually help with that. And I think that's certainly some of the areas that we need to look into. It's not just the bank's own KYC, AML, and other regulatory requirements, but it's also then, in terms of like assessing the actual underlying companies and corporates, it's also then around footprint association and the global network. Then, of course, other things that play a role is certainly system reliance and resilience, expertise of the actual people involved in trade, and of course overall sort of like processes. So yeah, I mean, as I say, I don't want to start thinking about resolutions just yet, but I think definitely when we look at the problem right now, the dominant factor seems to be really the regulatory framework and the regulatory requirements and the cost of compliance, so to say, much rather than, let's say, the cost of credit or the availability of credit. So if anything, there is a positive here in that we can see that lots have changed since the global financial crisis when it comes to that. Also, of course, thanks to the good work and help and support of international bodies such as the supranational agencies that are supporting credit relationships where, let's say, a commercial bank would not be necessarily happy to provide credit appetite for a transaction.
Excellent. Thank you very much. I think that you've done a really great job of showing the different confluence of factors that have contributed to the situation that we are in. And as you say, we will delve into a few more of those and how we can respond to them very, very imminently. Before that, Alex, I mean, could I ask for some of your opening thoughts as well?
Sure. Thank you so much. Yeah, right. Indeed. I mean, the $1.5 trillion gap, I mean, it does represent a lost opportunity for growth that most banks are currently overlooking for a number of reasons. I absolutely agree with Johanna. Most of those the applications that are rejected are by SMEs. I think it's around 40%, if I remember correctly. As a software house, we definitely have seen some improvement in these regards. Many institutions are preparing to serve those SMEs with new technology, but we still have definitely a long way to go. Most financial institutions believe that some of the aspects that are preventing them to closing the market gap is definitely the KYC, the anti-money laundering reasons, but also the lower credit rating of the obligor or the high cost of penetrating the SMEs market simply. The financial institution system cannot really rely anymore on the standard relationship manager that would go and find financing opportunities and to propose trade finance products to those companies. It is very archaic. It is not reliable, and it does not provide a successful onboarding of the client. On our side, we have seen, for example, that many institutions are still using custom-made monolithic architectures. They are very difficult to change, and for some example, if there is a new product to be launched on the market, it's very difficult to change. And many of them still use a paper-based application form, and that basically ends up in a double entry or triple entry of the same data by different people. So that's really not something that we can continue to do. Sometimes even the most highly digital banks, they do not offer a satisfactory front end for their customers. The use of this new technology will definitely create new growth. And for example, with artificial intelligence, they will create more efficient and definitely more sustainable trade finance channels. I think here, especially these days, the real question that we should be posing ourselves is, we have been having a trade wars, imposition of trade barriers. We have the new economic recession posed by the quarantine. Our question here is, can those banks still avoid this new technological improvement? They are facing low level of growth, thinning of margins. Can they still refuse to serve even the most problematic customers, which we all know there are SMEs?
Yeah, fantastic. There's really quite a few things that I might want to follow up on. One of them, and actually Natalia, I can see, has asked a question in the chat box as well. Hi and welcome, Natalia, for that, and thank you for that question. It is a good question, Joanna, and what I'd like to do is just broaden it out a little bit, because Natalia asks, is it 80% of SME loan applications that are rejected? That's a figure that she has seen elsewhere. And maybe kind of in tackling this question, because I know that figure probably varies, but is there also a difference between, and as you alluded to before, between a trade finance gap and a gap for kind of bankability as well?
Yeah, no, that well, it absolutely, Hashem, as you rightly say, that figure will certainly vary. And I mean, know where this particular figure has come from. It looks really high, and to be honest, I wouldn't know whether that's reflective of, let's say, the UK banking industry, or whether that's reflective of a particular institution, or whether that's more a global observation. I'd certainly say that of course, when it comes to assessing credit applications, and therefore also assessing applicability of whether a client can be provided with trade finance lines, banks certainly need to make sure that, as they are in the business of lending money, that they believe credibly and that they are going to be repaid. But this is exactly where banks can, for example, use an ever-growing toolbox of government help, so to say, whether that's by using supranational agencies that are particularly there to support trade finance, particularly in peripheral countries, by giving guarantees for up to 100%, or whether that be UK government agencies such as UK Export Finance, whose aim and target really is to ensure that no valid export or valid trade transaction as such would fail due to a lack of credit appetite. So there are certainly, as I said before as well, I think since the GFC, a lot has changed in that regard, in that there is a larger sort of like array of options for banks to go for in terms of mitigating credit risks and getting comfortable with different credits. So yeah, I think, well, again, as I say, I can't really comment on the numbers as such because I'm not sure where these have come from. But I say ultimately, if there is a viable proposition, then banks will really go out of their way nowadays to find these. And I appreciate that there is still companies who are struggling, and that's why there is also a lot of alternative lenders in the market that we're seeing, for example, in the UK, outside of the banking sphere.
Fantastic, thank you. And yeah, maybe just to add.
Sorry, I've just seen that you were probably going to say the same thing, Hashem. I think Natalia is just saying where she got that number from, which was the LIBF webinar this morning. Right. Yeah, as I say, I wouldn't be able to comment on it as such, but I think ultimately a lot has changed and improved in terms of credit availability for any sort of like viable exports really. But yeah, I mean, of course, there is also still companies struggling, and definitely that's why we have also alternative lenders for in the market. But of course, ideally, and again, particularly looking at my own institution as a British household name and a high street bank, we'd support as much as we can, and that really is the aim as well.
Thank you, yeah. And I suppose the one thing I was going to add to this is some of the time it can be a little bit difficult to know exactly whether it is 80%. In the same way, it can be difficult to know, is it $1.5 trillion or 1.4, 1.6? In that context, the most important thing to note, in my view, is the trend. So what's happened year on year on year on year? And the trend is pretty clear that the gap has remained about the same. The number of applications that have been rejected has remained about the same. And that's the kind of, it's that stagnation and lack of progress that maybe we want to tackle. Alex, of course, we want to try to tackle that using technology. You've talked about some of the bank architecture at the moment. I've always wondered, is it the case that because banks have sometimes invested in legacy architecture and they have that legacy investment, they need to continue to justify that before they can have a little bit of an overhaul? And maybe kind of in answering that question, you can tell us a little bit about the landscape as you see it from your privileged position. What are the technologies being utilized today by different players, and maybe what's most promising looking at tomorrow as well?
Right. Thank you so much. The idea is that we do know that most institutions are using legacy architectures. They are definitely accustomed to it, so there shouldn't be necessarily change their entire solutions. But they could definitely start looking at other possibilities. What we think is, especially in dealing with and communicating with their clients, I think some of the tools that could actually help in even shortening that gap that we're talking about could be definitely something that we all know and have right now: the online access 24/7, the full digital end-to-end process, and as I said before, a paperless. The entire process must be paperless, so it must be the electronic document management integrated with their solution. This seems quite obvious, but not necessarily. I mean, it's not that all institutions have actually applied this new technology. Also, for what actually concerns the customer support, I think it could be very beneficial to have the online communication channel, and that could be either via chat or video chat or standard in inbox messages. The idea is to support their customer in their everyday tasks. There must be less meetings, less phone calls, less in those sometimes for the very small, for very micro companies, less branch visits whenever there is still been if there's still been done. To optimize the cost that the bank has. The video chat could actually be very helpful for in those cases when they need to identify to verify the identity of the single person or to comply to the security requirements. And the built-in the inbox is standard. I know sometimes we'll use it whenever we need some additional support from our bank. Their SMEs actually need support from the bank. What I think is very important that each bank should do is to mirror the end customer internal process in order to have the same approval workflow, so that the company can actually have that already mirrored in the home banking. What is very important, let's not forget, we actually said it before, the anti-money laundering. We can definitely use the artificial intelligence to reduce cost, to do a deeper analysis of true money laundering cases, and even to reduce the many false positives that sometimes we are facing. In terms of online onboarding, as I said, we can do it online or through the mobile. We can definitely use artificial intelligence in this case as well for automatic identification. And another possibility could be the Swift integration with a global identity database. We have many possibilities here. One thing that we actually always recommend is that a fully integrated trade finance solutions should be a one-stop stop. It must be at the marketplace. You're already communicating with your client. You know who they are. You know what they're actually looking for. You shouldn't be waiting for them to come to you to whenever they need something. You should be more active and look at them and propose actually to them any trade finance line or any credit line, rather than waiting on them for you to come to you, because of course the competition is fierce. It's going to come, and eventually they may be switching banks.
Fantastic. Thank you very much for that. And I think it would be a good point then at this juncture to get some of the audience's views on a similar sort of question. So you can all see that there's a poll that's come up on your screen. In terms of the trade finance business, what are the main obstacles for IT change in your organization? So you can see the options there: implementation costs, implementation time, the lack of standards, the customer's low digital responsiveness, or other. If you can just vote, and we'll get to see whether you share some of our views as well. Joe, what do you think the audience is going to vote for?
Oh, tough question. I'd say international standards might be one. High cost of implementation might be another. And long time. Although I wouldn't say it's probably long time is probably relative. I'd say what also can of course affect implementation is just, again, it's a cost factor. Is having enough hands on the pump to actually get systems upgraded.
Great. I think we should be able to see the answers on the screen very, very shortly, unless we're saving them as a surprise for you afterwards as well. I mean, oh, sorry, just reading some of your comments as well. The question of implementation costs as well, Alex, I suppose that really does vary on, which of the solutions that you talked about before we're referring to, because different solutions will come for different implementation costs. If we look at something like AI, and I think that the point that you raised about using AI to try to counter some of the money laundering, potentially to counter forgery, and it's very interesting we have this webinar this week, because just a couple of days ago, we found out that perhaps the world's most renowned investor, Warren Buffett, was himself the victim of a fraud. A company that he invested in, a German manufacturing company, had been kind of forging invoices to try to make their position look much better, which kind of, it's a little bit daunting. If the world's most renowned investor and a multi-billionaire can be fooled by it, what hope for the rest of us? But maybe you could talk a little bit about costs, and I think the audience would be particularly interested to hear about AI, because we hear about it quite a bit. But what exactly do you think it could do?
Right. I think many institutions actually see the implementation of new technology as an obstacle rather than a tool to ignite growth. Definitely. I mean, we understand that implementing new technology requires definitely investing time, money, people, and resources in general. But they should be this new artificial intelligence, new technology in general, must be looked at as a solution to their needs. The platform must be configurable to what you're actually looking for. The answer today is automation. And if we use the appropriate methodology, the appropriate methods, this will not represent a risk. As I think this is the answer. I mean, of course, it seems strange, weird, and sometimes people always keep doing things as they've always been done in this institution. We all know this. It's very difficult to accept change, to embrace change, but at the end of the day, it will actually save money. It will actually save time and resources that the bank is currently using right now.
Fantastic, thank you. Andrea asked a very, very good question as well on the prospect of technology that can help. Is there a possibility to introduce a sort of electronic promissory note for the smaller transactions, which could be discounted by the banks? Joe?
I love that question, actually, because I'm very passionate personally about promissory notes and bill of exchanges, which is when I was saying before, we have some instruments in our toolbox as trade financiers that we've been using for centuries. These ones are certainly amongst them. So that is a great question, Andrea, and definitely to create and develop an electronic prom note or an electronic bill of exchange is certainly, I think, definitely one of the targets of the industry at the moment, and that's definitely one where the bank tech firm provider collaboration is progressing quite well. There is wider work underway, actually, with some of the main trade finance industry bodies, including the International Chamber of Commerce and the International Trade and Forfeiting Association, who've actually just launched an initiative on electronic negotiable instruments. And really, the reason why they launched that initiative as two industry bodies, who of course themselves wouldn't be the ones writing the code or creating the tech or then implementing it in their respective bank systems to use it. The reason why these industry bodies are getting behind it is because it was noticed rather quickly that technology is extremely advanced these days, right? And technology can achieve a lot of great things. What is lacking a little bit in the industry right now is a full sort of like set of international standards and what works with these instruments, and what is applicable in one country. Can we also make sure it is applicable in the other? Which, of course, if we look at some of our trade finance instruments, the more traditional ones, we have very clear sets and rules, such as the uniform customs code for letters of credit, which therefore makes it really easy to process LCs in sort of like any country almost. Whereas we definitely lack a bit of an international standardization for some other instruments. So that is certainly one of the things that is on the agenda of the industry as a whole, and certainly I think technology firms will play a very important part in that, because no bank alone will wants to nowadays develop these instruments on their own, because the most important thing is collaboration across the industry, and that certainly involves collaboration with the technology companies rather than trying to invent things in-house as such.
Fantastic. Thank you very much. A very comprehensive response there, Joe. And actually, that question of collaboration neatly brings us on to another point, which is there's long been a discussion, Alex, about the balance between competition and collaboration that fintechs can provide to banks and have with them. Where do you see us being today in terms of that balance?
Look, in my opinion, I believe that, of course, smaller like fintechs, smaller institutions like fintechs definitely are more flexible. They're more apt to dialogue with companies that definitely have a business model that is definitely more approachable even by their clients. That doesn't mean that there must be a competition between that. They can definitely collaborate. Banks need to upgrade their system, their model, in order to be able to compete and work with them. They need to do so to not lose market share, to gain the confidence in their clients. They do have some sort of an older approach, especially, and I think we should do this, especially because the financing needs are constantly changing. So maybe we shouldn't a static model they was done in the past is not the answer that we should be done today. Fintechs are definitely more, as I said, flexible, and they can definitely be more helpful sometimes to compare to larger institutions that definitely have more a longer process. Decision process is definitely longer sometimes. But it doesn't mean that there isn't space for all of them. I think they could actually learn from each other, both fintechs and large banks.
Fantastic. And one gets the sense that with the scale of the challenge that we are now facing already, even before the introduction of COVID, that sort of synergy and collaboration is going to be absolutely necessary. Now that we've started talking about COVID-19 a bit more specifically, there's a question from Dimitri. Dimitri asks, do you see any COVID/post-COVID related measures and tools which may limit the trade finance gap now? In Central Asian, Eastern European, Caspian region, we can see that fear of logistics and trading interruptions are having a bit of an impact. And that kind of, I think that's a very good question. That's a pretty specific question, but maybe focusing on that, Joe, and then the broader question that I think that's relevant for everybody is, what and how will COVID change? Is it going to change in terms of resources? Is it going to change in terms of the focus and the emphasis on digitization? Maybe you can start to answer this big question for us, and then we can we can follow up.
All right. Yeah, I will try my best, Hesham. Let me start with the first bit of the question first, in terms of Dimitri being concerned about the availability of trade finance in certain parts of the world, such as Central Asia, Eastern Europe, Caspian region. I think again, this comes back to overall looking globally at the trade finance gap. What drives the gaps? And the gaps are being driven, as I was alluding to before, majorly by actually nowadays regulatory aspects, and therefore banks simply not being able to do business in every single country anymore. And then of course also by credit considerations. And particularly, looking at, for example, looking at Central Asia for one moment, it's a massively vast and big region, but I wouldn't say it's necessarily quite overbanked, simply because it's a very vast area and a very vast region, but it's simply not home to the largest number of world population as of today. So certainly, I think there is again the element of needing to ensure that there is enough credit and there is enough international correspondent banking relationships in these parts of the world, and both I think in a post-COVID environment, certainly even more, because right now it is important to make sure that these supply chains are all working. I think, again, governmental bodies, whether they are supranationals or whether they are national governments, can actually play an important part here from a credit position, and can support that process. And then at the same time, it's important that banks can actually reach in these regions and have the relevant correspondent banking relationships. So hopefully that helps to answer that question. I think then looking at what we're seeing now in terms of the current COVID environment and what we think post-COVID will look like. I mean, it's probably obviously still very early days to say. There is a lot of different aspects, of course, that are completely fundamentally changed now in our lives. Whether that's be companies talking about working more flexible working environments and actually people working from home and remotely a lot more than they used to do before, or whether that comes to like personal choices in terms of travel, etc., or when it comes to actually the trade world. Certainly, the trade world has been pushing for digitization for a while, but trade is a very complex field, and I'm stating the very obvious here, which is certainly one of the reasons why digitization has not accelerated as much as, let's say, for example, in the payment space. Although, of course, trade could really do with digitization across many factors of the value chain. So I'd say this has certainly forced that agenda and that issue to drive for greater digitization in the trade world. What is really important there, though, is also to always consider the risks, of course, and particularly in a trade environment, you need to make sure, of course, that you not just consider your credit risks, but also and your sanctions risk, but also your fraud risks, etc. And this is, of course, where you need to make sure that whichever technology you use is absolutely bulletproof and doesn't actually open up to you more risks than whether that be as a corporate, as a company, or whether that be as a financial institution. Than, let's say, in a less digital environment where we would be doing more paper-based. So that is really important, that the technology really can provide for that sort of like bulletproof environment.
Fantastic. And given you're one of the people tasked, Alex, with providing this bulletproof armor, how confident are you of being able to do that? What would you advise banks in terms of, and I'm just picking up on another audience question, please do keep them coming, but in terms of advising banks for what they should be looking for in a digital ecosystem for the trade finance business, and whether sort of those sorts of inquiries have increased in the context of COVID-19?
Right. As I said before, I think we should definitely look at something that would allow for the digital channel to be with a full access for 24/7. There must be the entire process from the start to the very end must be fully digital. There mustn't be any sort of outside offline communication or sending of documents outside of the platform itself. And it must be totally paperless. Again, this is very, very important. I think you could rely on on new technology for the digital onboarding rather than waiting. I know that the KYC and AML and the onboarding is something that is a heavy burden for institutions. It takes a long time. It takes a lot of money. I think you should rely on that technology to improve that aspect of your institution. Look at, for example, as I said, the video chat to verify the identity that has already been used in some institutions, but more especially the artificial intelligence for the anti-money laundering. That would help to reduce cost in do a deeper analysis of those cases that you believe are real money laundering cases. Even then, like the standard rule-based system that many institutions use now for anti-money laundering, the transaction monitoring, that actually produces a lot of false positives. it's very important that we're going very technical, but it's very important that you actually have a system that could actually help you out in understanding what are the false positives. Let the system understand what is actually going on in your transactions, and let the system advise you what the AML analyst should be looking at. The real cases of anti-money laundering. And again, I think it's very important to say the marketplace. I think your platform should be a way where you are definitely more reactive to the client. No, you're very active towards the client. Don't react just to their needs. Actually, go there and propose credit lines they may need. For example, we have seen sometimes that there are some new technology that are actually proposing the company how a credit line same day for a specific invoicing, the invoice that actually is coming in. They have to pay maybe the next day, and the bank the day before actually proposes that a credit line for same day, a credit line for a couple of days, or I don't know, a specific amount of time to be able to face that payment, because maybe they know they don't have enough money in their account. So you should be looking at all the different sort of possibilities.
Excellent. And I think that ability, that transition where software providers and technology companies are using the wealth of data that they have and then translating that into intelligence for the client, that's the sort of thing which, when I speak to kind of banks and corporate treasurers on an ongoing basis for TXF, conferences, interviews, and so on, that's exactly what they're looking for, especially if we continue to see maybe more concentration in terms of their teams, maybe slightly more streamlined operations, then the ability to be able to have a software ecosystem which automatically is kind of, it's a little bit like your iPhone, and, kind of talking about technology and how every day it is. Every now and then your iPhone will just give you a suggestion. Do you want to set an alarm at this time? Because you've been setting an alarm at that time every day for the past month, but you haven't done it this time. So it uses that data.
Exactly.
Maybe you have forgotten. And yeah, I think taking these sorts of retail space innovations and putting them into the trade finance space would really signal some positive progress.
Yeah, I mean, they should be using the technology to understand the behavior of their customers. They know the transaction, they see the movements that actually the company does, so they see where it's more active. Maybe they may need some insurance cover and for a transaction in, I don't know, Latin America versus Asia. That's something that could also be proposed through that marketplace.
Mm-hmm.
Yeah, and if you could see me on the screen right now, you would see me nodding. I think indeed. Big data, of course, is a field that we speak about in our everyday life, whether that's in the context of finance or in general. So indeed, as technology advances and as particularly AI applications advance, that is certainly, I think, a big area that can help, not just even in the AML and anti-money laundering, in the AML and KYC space, but also in many other fields, including also in the credit cycle as well, and to basically be able to analyze and see risks in the system as such a lot quicker and a lot earlier on. So yeah, absolutely. And this is certainly, these are the type of applications that, let's face it, banks are lending institutions first and foremost. There aren't technology firms. And as such, I think working with technology firms is really the most important aspect here, rather than trying to invent something in-house. And that's certainly something that I've seen change in the industry over the last 5 to 10 years. From being an initial sort of like when fintech was first very popular and very on vogue, and tech companies entering the space of finance, it was pretty much a very competitive space, and a very much like where fintechs were like, we're going to eat your lunch, and banks were like, yeah, you want to eat our lunch, and we don't want our lunch to be eaten. Whereas right now it's a very collaborative space, and I think that has already made us advance a lot further as industries as a whole. It's really become a much more collaborative space in that respect, and I'm sure it will continue like that.
Super. I'd like at this point to turn to our esteemed audience once again. So we have another audience poll question for you. It should be up on your screen. In terms of your trade finance business technological architecture, do you believe your organization will need to change within the next 12 to 18 months in order not to lose market share and to better penetrate the market? So this is asking about, your plan over the next 12 to 18 months. Is it already there? Do you have a plan to change within 12 months? Is a plan to change after 12 months? Are you already doing it? Or are you not currently actually planning on this? So please answer this. All of the answers from these polls will be sent to all of the attendees afterwards, as well as the full recording, as I mentioned earlier. So as the audience are giving some of their thoughts on this, Alex, maybe you can kind of elaborate a little bit on maybe some of the importance in trying to get ahead of some of the market changes.
Right. I think you should. I think at the moment banks should start understanding what are the benefits of implementing new technology. As Joe said very clearly, they cannot be expect to be doing everything by themselves. They maybe don't have either the technology itself, or they don't have the expertise. They're not aware that there's some specific technology that is being brought on the market. Try to understand also, if I can give an advice to those banks, try to understand what is actually that you're looking for. Are you looking to reduce manual work? Are you looking to streamline the process? Are you looking to put a possibility to implement new products? Do you want to reduce operational costs, because we all know how much they are? And most importantly, I think most of them, they actually want access to new clients. I think that's actually, these are the reason that what you should be looking at. What are the actual, why would you want to change that, your current architecture? Look out on the market. I think, as I said before, there are many new technologies that have been built. For example, we mentioned the AI, but there is blockchain, there is cloud microservices. That's very important right now. And I think that's something you should be looking at. We see that there are many partnerships right now going on between institutions and fintechs and software houses like ourselves. They want to work in a shell technology, the efforts. For example, we mentioned it before in the case of KYC. There are a few that are actually very, very important, and they're actually very interesting. So this is something that I think the market is going to look like in the next months.
Great, Joe. I'm going to put you on the spot, and if you were taking this poll, which one would you answer?
I need to be careful, right? Because I might not know the correct answer, but in my opinion, right now the platform actually that we have is pretty state of the art. Which is due to the fact that we've only just upgraded quite recently. That being said, as a company that certainly is on a global scale, not one of the biggest financial institutions out there, we are always very actively striving, anyways, to also work with external technology providers. So while we have a very state of the art internal platform, we are working a lot also in other fields with external providers, in whether that's trade receivables, whether that's supply chain finance, and risk distribution. So we're quite open-minded and active in that space.
Fantastic, thank you. We are reaching the final few minutes, so I would just like to encourage you, if you haven't already submitted your question, please do so, and we will get through to it before we finish. I'll stay with you, Joe, for a second, because there was a question. Now, you've already touched on ITFA and the ICC in terms of the work they're doing to help to align digital standards. There was a question from Martin who asks, are international bodies like ICC doing enough to encourage incorporation of more technological elements into international trade? So not necessarily just focusing on alignment of international standards, but also taking a look at just pure advocacy and the kind of communication of some of the benefits.
I would generally say absolutely they do. It might not always look like it, because they don't shout about what they were doing on a day-to-day basis. But generally, there is actually a lot of work going on at, for example, the ICC in terms of various working groups that are particularly focusing on the one hand on standards, but then also focusing on particularly the tech aspects and how you can make it easier to make these applicable on a global scale. So there's other working groups which deal with another very important topic, which is sustainability and ensuring that we generally will meet the ESG goals. Absolutely. Industry bodies, I'd say, are as active as hardly ever before the last few years, which I think again is because it is being recognized by everyone in the industry that this 1.5 trillion gap is way too big, and obviously we want to minimize it, but we also need to stop it from getting even bigger. As I was saying in my opening remarks, that actually there is some talk, and I don't want to sound like doom and gloom here, but there is some talk that it might actually further widen. So on the one hand, we need to stop it from getting bigger, and then obviously we need to minimize it. So yeah, there is a lot of work underway. I would just say it might not always be as visible, but from what I can see in the industry, these guys are quite active.
Fabulous, thank you. We have another question as we continue to make our way through the audience comments. So the question is a bit more directed at you, Alex. It asks, how comprehensively are technology ecosystems currently protected from cyber threats and the costs associated with these? And I suppose, I mean, generally speaking, because we've talked about quite a lot of the opportunities inherent to digitization and technology, but it's probably a good counterbalance to also take a look at some of the things such as cybersecurity that people also need to be mindful of.
Yeah, thank you so much. I think that absolutely. I mean, all these like ecosystems are definitely super protected from cyber attacks. There are several things that could be done to protect your solution. That could be from, first of all, testing your current architecture if it's penetrable or less or no. We definitely, the ecosystem itself the new ones definitely are definitely protected. There are many applications and sign-on mechanisms that could be integrated. Absolutely, I think they are very safe. Actually, I think they're safer than most solutions that have been used in the past. Absolutely, I think it's safe to say that actually they are better in this regard if you integrate them with the right security protection system.
Brilliant, thank you very much. Look, unfortunately, and I think we could actually go on for quite a while, but unfortunately, we're getting very close to the hour mark. So I want to try to wrap this up a little bit. We started with some tips. Indeed, the tips were about working remotely and music to be listening to. But I'd like to also finish on some tips and advice. So I think it's pretty clear that the only certainty we have in terms of the market and in wider society is change. In your opinions, and I'll start with you, please, Joe, what will define those who are successful during this period of change, of transformation, and how can stakeholders try to leverage some of that?
Yeah, let me try and be very brief because I'm conscious of time. You already mentioned it, period of change. What is really important is to remain agile and be able to adapt. The world as maybe our great grandfathers or so have known it, where things might have been slightly more static, has ever always changed, right? And it's as important as never before, I think, to just be agile and try and adapt as quickly as possible, and always be happy and ready to not just follow plan A, but also consider plans B, C, D, E, etc., etc. So yeah, that would be my advice.
Fantastic, thank you. And Alex, your closing comments on that, please.
I think in 2 words, be flexible. I mean, I absolutely agree with Joe. I think it's that is the answer. We don't really know what's ahead of us. We both on a personal level and work related business. Be flexible, be prepared, and accept the change that eventually might help you grow eventually as well.
Fingers crossed. Fantastic. Thank you very, very much.
Thank you.
Ladies and gentlemen, you should now
Thanks.
see a survey coming up on your screen. I'd really like to invite you to fill out the survey. It will really help us in order to try to make sure that we're giving you all of the information that you need and that you want. As you're doing that, it really remains only for me to give you a couple of notices. The first is you'll be able to see all of this webinar, including the Q&A section, and get all of the poll results directly from Comark, our kind host today, as soon as this webinar is over. So look out in your email inboxes for that confirmation. I want to thank Joe and I want to thank Alex for their participation. This is a really key fundamental topic. When we talk about the trade finance gap, sometimes it can seem like, oh, it's $1.5 trillion. It's so big. It's so kind of abstract. We need to really understand that that is millions upon millions of individuals, of businesses, of companies, of staff, of employees. That's the future of trade that we are talking about. So it's a huge topic. I'm very grateful to them for giving their thoughts on it and how we can improve it. And of course, I'm very, very grateful to the audience for joining us, for tuning in from all of the different countries that you did. Thank you very much, everybody. We wish you the best of luck in your business, and we look forward to seeing you at a future webinar very, very soon. Have a good day.
Thank you so much.
Many thanks.
Bye.
Bye.
Bye, everyone.